Interactive Brokers chief strategist, to talk a little bit more about, I guess, where the market's head is at right now, Steve. And obviously there's a lot of jitters, at least in some of the day-to-day moves here. Longer term, are you confident? Do you have some confidence here that the Fed is going to be able to thread this needle?
Good afternoon, Romaine. In a short answer, no. I think that it's what the Fed is being asked to do is incredibly difficult, and I think investors have been giving the Fed some degree of leeway. Certainly, equity investors are much more charitable, I think, than bond investors. But what they're being asked to do is incredibly difficult. I'd love to think that they can thread this needle, but what they're being asked to do is deflate one of the biggest balloons that they've ever inflated. And it's hard to do that without some side effects.
Steve, curious what you think about the internals of the market. Taking a look quickly here at the 100-day, which is slowly about to cross back down over through the 200-day moving average on the S&P. How do the internals look to you in this market?
The internals look a bit dicey. Now, one good thing is until the events of, until, let's say, yesterday afternoon, I would have said that there had been a very healthy rotation. We were getting out of some of the big cap tech leaders into some broadening, which is a good thing. You want to see broadening leadership. The problem, again, when I was, in terms of the market mechanics, if people start to abandon the stocks that brought them to the dance, the mega cap techs, and I'm actually excluding Netflix from that equation at this point. It's hard. The math just says if people are leaving those stocks, the broader indices are going to have trouble.
I'm wondering also, when you look at the S&P and the 3-day decline, despite some promising earnings we've seen, how much of this is because of inflation to the companies that are feeling it, and how much of it is because investors just don't really believe that the consumer will remain this strong into the year?
It's tough, Shanali, because I think I think the Netflix results, there's a lot in there to unpack. But the bottom line is people are cutting back on their Netflix subscriptions. They're starting to go towards staples. Kimberly-Clark is fine in the short term because people are not going to skimp on tissues and toilet paper, but they may skip on that extra streaming subscription. I think you're starting to see a time where defensiveness pays. Another part of the problem is we got off to the earnings season with banks, which was okay. Yeah. But I always consider, if earnings is a 9-inning game, banks are sort of the national anthem. Yeah. You need to do them. You need to get through it to get the game started. But whether or not Bank America had a good trading result doesn't really play into the real meat of earnings season. And we're getting through that now.
Okay, well, let's go there, Steve, here, because next week we're going to get a lot of names that do fill out that tech space, that discretionary space, the Microsofts, Apple, Amazons of the world, Meta Platforms, which today is trading at a 52-week low. You get Qualcomm, General Motors, a whole host of companies that should give you some more insight into consumer spending and, to a certain extent, business spending here. If we get significant misses, not only for the quarter, but maybe a significant disappointment with regards to that guidance, do you think that the market has, I guess, more room to move lower, or has some of the worst-case scenarios been priced in?
It really depends how bad it is. One of my key things coming into earnings season was how would we deal with disappointment? In the case of Netflix, not well, and in the case of other stocks, not well. I think there's a lot of the problem you have is so many of these stocks have such lofty growth expectations baked in. Think about it this way: Tesla blew out its numbers, 30% above where people thought it was going to be, and the stock moved up, call it 7%. It did fade a little bit at the end of the day with the market. Well, 7% up was what was expected going in. That was literally what I published, was the option market's expectation. So essentially you had this great result and it was priced in anyway. So I think what we're seeing is some of the deflation of some of the deflating of that enthusiasm.
Steve, I want to be careful here because our audience are really long-term institutional buyers. So I don't want to hype up a 2% loss on a Friday going into a weekend. But do any of these sort of 2 to 3% sell-offs provide attractive entry points?
Oh, absolutely, Taylor. When you have moves like this, there's always stuff that gets thrown out, that gets thrown aside, along the way. There's always going to be bargains to be found. What we're getting is volatility, and volatility works in both directions. And so if you're a long-term investor, you want to use this as your opportunities. Hopefully, you have your entry points in mind, and in some cases, the stocks are going to provide them. It does get a little trickier with earnings coming out because we don't really know what's going to happen with them. That's one of the known unknowns in the market. But yeah, I don't want to get people freaked out by a two-day swing like this. But I do want people to be aware that this is going to be what we get, is volatility up and down.